Hi, everyone. This is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He was actually my mentor in the gold and silver markets. He's published a number of gold and silver books. He's written a commodities and precious metal paid newsletter for decades now, the Morgan Report. David Morgan, thank you for joining me.
Well, Jason, thanks for having me.
So, David, before we talk about gold and silver miners, royalty and streaming companies, and you have a lot of expertise there. A lot of my listeners are not aware that you actually built a royalty company and then you sold it. I want to get your thoughts on the global macro situation right now. We have the dollar index. We're recording this interview on Thursday, August 18th. The dollar index is above 107 at 107.5. Gold and silver, we have gold prices at 1,758, silver at $19.52. But what do you think are the biggest risks to the global economy right now?
That's a great one. I mean, I'm going to go on a bit of a tangent, but I'm going to answer your question, Jason. I mean, you could say, oh, it's a supply chain. Well, yeah, that's part of it. I could say it's, the decrease in foodstuffs for weather, locusts, crop failures, a lot of reasons. That would be part of it. I could say the geopolitical landscape with the war in Ukraine and Russia and what's going on with the BRICS nations, and that would be part of it. But if I boiled it down and really thought about it, it would be trust. We have lost trust. We don't trust each other, meaning Russia doesn't trust another nation. America doesn't trust other nations. And so look at the Russia-Ukraine thing. I don't want to dwell on it, but the Minsk agreement was very, very clear. And it wasn't Russia that broke it. It was the West that broke it. I'm not trying to be favorable to either side. What I'm trying to maintain here is that the basic laws of how a society is structured that works is you do whatever you say you're going to do. In other words, you keep your word. There's trust built on integrity, and that's been lost. So I would say that's the main problem.
Well, didn't you have the U.S. government, the U.S. Treasury, and the federal government change the rules, right? And they tried confiscating or did confiscate or at least froze the Russian foreign exchange reserve. So Russia dumped their U.S. treasuries quite a few years ago. I don't think they really own any or very little net treasuries. It did not crash the U.S. Treasury market like a lot of people in the alt media and gold community were predicting. But Russia is one of those countries that has been a very big net buyer of gold.
Absolutely. I mean, at the end of the day, at least in history past, it's always been what you can trust the most in the monetary sphere, and that's been gold and or silver. And this is what's taken place. The big move really is, if you look at it from a Austrian school perspective, wealth is the means of production. The more stuff you produce, tangible stuff, real estate, cars, machinery, art, whatever, that productive capacity is capitalism or is true wealth. And whoever holds the productive capacity at the max is the leader. And so we've been shifting from west to east for a long, long time. Most of the jobs have been offshored and NAFTA. I mean, we don't have to go all the way into it, Jason, but the idea is very clear. And also, what's so interesting about that is if you follow the money, or really, and money means gold, then you'll see that when the British Empire, the sun never set on the British Empire, they had the productive capacity, they had the most gold. And then it shifted to the United States, where they were the main productive capacity of the planet, and they had the most gold. And now we're looking at who's got the most gold and who's got the highest productive capacity. It's pretty much China and Russia. So it's not a big surprise if you know what to look for. It's pretty basic, but there are a lot of people that just are not able to see with their eyes what's really going on. So we are in for some very interesting times, some very difficult. There'll be a lot of social problems. There'll be a lot of wake-up calls, I call them, Jason, because a lot of people that have been more and more and more dependent on the system will find out as the system unravels more and more and more, they'll have to become self-reliant. It'll be forced on them. That idea of getting that whatever handout that they may be getting now could go away. In fact, in some instances, it will. It's almost guaranteed. And on the other side of the coin, those that have pretty much done whatever the system has asked of them, and they've saved money, and they've got a pension plan from an employer, and then they find out that the corporation they're working for had to borrow money to pay dividends for the last 5 years, and the corporate bond structure is upside down. It's called as a zombie corporation, and they defunct. And now that pension that they were getting for 3 years has gone away. So there's a lot of problems out there. I'm not trying to be Mr. Doom. I am a realist, as you know. You've known me for years.
Well, you got to invest based on realism, right? Not on hope.
That's right. You can't bet on, I believe it's going to be a better year, or I believe there's going to be a discovery at this mining effort or whatever. Now, you have to go with what is.
Now, you've also given presentations at investing conferences over the years talking about the derivatives market. Do you think that is still a major risk for the global economy?
Absolutely. It's probably the number one risk. I mean, almost all these derivatives, there's so many, but almost all of them are tied to an interest rate in one way, shape, or form. And that's a real problem, because so many of the what we consider establishment investments, like a life insurance policy or an annuity, or maybe the teacher's pension fund. These are all tied to the bond market and interest rates. And these interest rate swaps and derivatives can get extremely exotic, where it takes, 3 quants in a room and, dead silence for 4 days to figure out what the true nature of the derivative is. I mean, I'm not really exaggerating very much.
It's even worse than that. I spoke to a former bank employee. This was an off the record conversation. They said that some of the derivatives that these European banks own, they don't even have clear chain of custody, and they're old contracts that were written in the 1980s, 1990s, early 2000s, and they're not even on a computer file. So they're old paperwork and they can't find it. And it says one contract will say it's owned by one bank and one will say it's owned by another. So there's large amounts of these contracts and they don't even know who owns them, really, the title.
Wow. Yeah, that's the system, is how corrupt it is, how corrupt it's become. There's always, some cheating or whatever in almost any human affair. But, when you have that integrity that we talked about, where you keep your word and there's trust, a great deal of trust in the system, so much less. At the end, just like the end of the Roman Empire, basically the senators had all the wealth and the people were left on their own, starving some in cases. And it's kind of repeat performance now. I mean, you look at the political class in this country and you say, well, how can you come in making, this salary and come out, with 5 million, 20 million, 60 million, 100 million after a few years as a Congress critter? Well, because they're corrupt. They're bought and paid for. That's how it happens. And anyone that doesn't know that is living under a rock.
Or you have the case where it was systemic corruption, systemic manipulation, with what we found out with the precious metal market manipulation case, and the JP Morgan, the bosses and the traders were just convicted, and they outlined just the amount of spoofing, and that's just the tip of the iceberg for manipulation. I think, David, and you've been around longer than I have, but I remember 2012 when the paper gold price was just absolutely brutally smashed. We found out details that there were 3,000 or more spoofings per day. And they didn't care if they were committing a crime, because they said everyone in the bank, it was assumed that they would do it and get away with it, and that no one would get charged, no one would go to prison or anything like that.
Yes, I'm aware of that. And, and it's funny because you still get apologists that, spoofing only lasts for a few seconds and doesn't mean that much, and it's business as usual. And they, no one had the RICO charges against them, just spoofing. That's all it is. And of course, spoofing isn't manipulation. Well, then what the hell is it? And so, that's the establishment's perspective, which they're allowed to see it a different way. I think they see it a different way because of their bias. But I'm biased as well. I mean, I'm for freedom and free markets. Those that think that the banking elites should be in charge obviously would have a different perspective than I do.
Well, but spoofing, though, if you look up the definition of spoofing, it's fake orders. So they're putting in fake orders. So they're telling the market that they're going to buy at a certain price, and they're pulling the orders. It's like pulling the rug out from someone. And they did this up to 3,000 times a day. So, I mean, Yeah.
Sorry, I didn't mean to jump in too early, but, one of the apologist is talking about, well, it only mattered, just lasts for a couple of seconds, whatever. Well, that immediately drew to my mind. I forget which bank it was that moved like 3 or 4 blocks closer to Wall Street for their computer algorithms to get, 0.00001 second faster than the ones that are, 4 blocks behind theirs. So it does matter. All these things, most of this trading in the stock market and the futures market is done with algorithms. It's computer against computer. And of course, there's still some, traders that do it, manually, and then there's a public that's so naive, they think that they can beat these professionals, and occasionally they can, but overall, they're much better off in the equity side, which, as you well know, is where I've specialized for years. I think it's, I wouldn't say there's no corruption, but there's far less, and it's easier to detect. And if you structure the portfolio correctly, if you know what risk assessment really means, and you mitigate the risk, you can do quite well, as we have done. Certainly not perfect, and I've made some bad calls, but overall, if you apply the principles that work with investing in general and apply it, especially to the mining sector that has some special situations, the way that these royalty companies are set up, you can invest. Invest to me means you put money in and, don't worry about it too much. In 10 years, 20 years, 30 years later, you've got a nice increase at 10, a really nice increase at 20, and at 30, you're really, really happy. That's investing. But there aren't many investments in the mining sector, because you've got to remember that all mines end in failure. No matter how rich the gold mine might be, once you get out that last ounce of gold, you're done. You failed. You finished your business. You've got to renovate the mine site and move on. And of course, anyone in the industry knows that. But my point being is, it's hard to find a good investment that you can just buy and hold in the sector. But there are ways to do it, as you and I both know.
So one of the best things about you is your experience with gold and silver. You've been through a lot of bull markets. You've been through bear markets. What normally happens for listeners who are not aware for metals prices, bear markets, and mining stocks in bear markets? Is capital available? What happens to juniors? What do you expect if the bear market for commodities prices, metals prices, and mining stocks continues?
Well, everything will get decimated if it continues. I mean, if you have really low prices in the metals, then companies that maybe have good assets just are not economic. In other words, the price of the metal is too low to make a profit, so therefore the mine isn't going to be put into production. That's one. Another one is the sentiment. I mean, once you see a certain amount of disgust in the market, a lot of people will capitulate. And those that are savvy enough to, let's say, have conviction, can pick up assets, pennies on the dollar. Of course, we're going to talk about that later in the interview, so a bit of a pre-interview. But there are opportunities always. There's nothing really much more important than mining. I mean, the energy sector is paramount. It's above mining, but mining is key. Without metals, nothing really takes place in society. I mean, even a bicycle in most cases is metal. If it's composite, that's graphene or graphite, or some substance, or plastic, which is an oil-based thing. So I mean, you can't get around it. No matter how much of a environmentalist you feature yourself to be, driving a Prius or a hybrid and all this stuff, the facts are different than what most people that are in that, let's say, sector actually understand.
Yeah, I totally agree. You've said in your books and also in past interviews over the years that everything that's not grown has to be mined.
Exactly. And that's a key idea that's very simple to grasp and understand and admit it to yourself. I mean, this idea, again, that, you're above everybody else because you ride a bicycle to work. Good for you. I don't care. I mean, I'm free market. If you'd rather ride a bike than drive, that's fine with me. But the idea that you're better than somebody or you're really saving the planet because you're doing that, you better rethink that part of it.
Well, most of the environmentalists, the green energy people here in DC are enormous hypocrites, enormous champagne socialist hypocrites. A lot of them drive $150,000 sport utility vehicles, or that are not even hybrids, or luxury sports cars that are not even hybrids either.
Yeah, I know. It's really ridiculous seeing that. I mean, me being conservative, I don't really affiliate with any particular political party, but always live within my means, usually save for what I wanted to buy. I find it really interesting that some of these people seem to get their self-worth based on some item that they own rather than what they have internally, which is unfortunate. But it goes back to our opening statement, trust. I mean, if you have true integrity and you really know what you are, who you are, and you have strong character, fame could come and go, it could fleet away, even riches can disappear. But at the end of the day, when all's said and done, it's what you have as your character, which really matters. But no one teaches that. No one talks about it. No one really even understands it. I mean, we're talking before the interview about the current scene, men-women relationship, and that's getting blurred with a lot of stuff from different mainstream news sources on, I won't even say it, but different orientations. And, so what? It's just that the amount of verbiage given to that proclivity is much, much greater than the percentage that's involved. And this gives a distorted picture. And that's, of course, what the mainstream has been doing on almost any front, giving a distorted picture of the belief system of the American public, of what the financial situation really is, of what the stock market really is doing as far as making new highs. Well, take the new high and put the DJI against gold, and you'll see what James Dines did way back in the 60s and 70s, called the invisible crash. The market kept going higher and higher and had a higher number. If you look at the graph, it was going up and up and up. But if you divided it by the Dow Jones Industrial in terms of gold, it was crashing. So there's a lot out there that very few people are really aware of because they just want to, be spoon-fed what the mainstream media pours out. They gulp it down and they think that they know what's going on.
I want to ask you about the state of the silver miners. So a couple weeks ago, silver got to $18.60. There was an emergency buyout. I would call it a shotgun wedding with Alexco, how Hecla bought them. I think long-term, Hecla is going to really benefit from that purchase. You can comment on that. But talk about the state of the silver miners right now. How bad would things get for the silver miners if silver had gotten below $18.60, say to $18, $17, $16? Would it be similar to the bear market in 2015, 2016, or maybe worse because of much higher energy prices with diesel, electricity, capital's not available?
Yeah, you answer your own question. You're very bright. I would say it'd be worse, as you outlined. I mean, diesel's far higher. You've got pretty much a wage price spiral starting. People say, well, I need more money because it costs more to drive to work and my food costs are up 40%. So give me more money or I'm not coming to work, kind of thing. And one feeds on the other. So yeah, I'd say worse. Plus the amount of viable projects. Now on the silver side, I'm pretty aware, since it's kind of my specialty, of deposits that have huge merit, but they're large. But it takes a lot of capex, a lot of capital formation and sunk costs before you actually put a mine of that substance into production. And I'm very much of the opinion that we're contracting the global economy pretty much across the board, that the best commodities will be the precious metals and the agricultural commodities. In other words, food, wheat, corn, soybean oil, soybean meal, all this stuff on the ag complex. And that you're going to see a deterioration in real estate. You might see pockets in the rural communities where you could buy farmland or have your own gentleman farm, or that those might maintain or maybe even increase in prices. But overall, your McMansion, I think those McMansions are going to be dead meat after a while. The reason I say that is because of cost of maintenance and the distance to go to work. I mean, if you've got a McMansion and you've got to drive an hour to work, and gases that make up a number, $8 a gallon, and food costs are double where they are right now, you do the math on that after you pay your babysitter to watch your kids do daycare while you're at work, and you do all the arithmetic, and you come out and you're not making anything. You just, you're on the proverbial rat race. You're spinning your wheels on the treadmill and you're going nowhere. You're staying in one place, but you're running like hell. And that's a pretty good metaphor for what I see taking place. And, most people refer to that as stagflation. And we have that, and we're going to have more of it. And I think it's going to trend further. And I think we're going to see pretty much, I'd say, a wipeout of the middle class, but a huge dislocation where you pretty much move this country, the U.S., into a two-class society. And that's very, very sad to me, because the middle class is really very important to a true capitalistic structure.
Yeah, especially for small business and entrepreneurship, they develop the capital. They come up with new products and services to, they take the big risks, and then grow the small business, and that's dying right now with stagflation. And you said in the past, and I agree with this, that Keynesian economics always results in stagflation. I think that's the best case scenario right now going forward.
All right, let's go back to Hecla. Hecla's been on our list. I've owned it. I knew Art Brown when he was the CEO, because I'm over here probably an hour and 10 minutes from their front door. I've been to their facility many times. Met Phil Baker when Phil took over as the CEO. And, even though it's an NYSE company and they're pretty conservative, it really hasn't been my favorite for a long time. But Alexco seems like everybody's brother-in-law's aunt's cat. Love that company. And I took it off the list for several reasons. But I knew, or I believed, that once the silver market took off, that stock would take off, because everybody seemed to love it. Well, as you know, Hecla basically scooped in and bought great assets for literally pennies on the dollar. And, we just did a write-up on Hecla, pretty in-depth. We do, as you know, Jason, pretty much Wall Street quality reports on these majors. And what's interesting, I need to comment on this, is I can't name names, but a retired New York stockbroker that I know quite well and have known for years really complimented me on the Hecla write-up. And then about less than a week later, I got an email from him that one of the stalwarts in the industry, I won't name names because I just can't, but someone that's right up there, I'll say Rick Rule, and it wasn't Rick, but someone of that notoriety had written an email back to this retired stockbroker why he didn't like Hecla. What was interesting is his comments were probably very similar to what mine would have been a year or two ago, but he wasn't looking with fresh eyes of what's really going on there. So I like your comments on it. I mean, you look into these companies, you write about them. What do you see with Hecla?
It's much improved. I mean, for many, many years, they were mediocre at best. They had mediocre or worse assets. They always had problems with their balance sheet. They always had problems with cost control. This company seems that the asset base seems much improved. I like how they were aggressive buying Alexco. They got the assets for pennies on the dollar. I think they got hundreds of millions of dollars worth of assets for about 80 million bucks. So when the silver market, not if, but when the silver market, because I mean, if the silver price goes lower, there's going to be even less silver supply online. There's going to be even less investment into new silver supply. When the silver market does turn, when the cycle does turn in the coming years, Hecla's probably going to mint money from it.
Yeah, and I have to add a funny story, Jason. I know you'll allow it, but this goes back to my age and how long I've been in the industry and all of that. But this is pre-Bitcoin, because before the cryptocurrency world, I mean, the best place you could see pretty much to make huge gains quickly were in the precious metals, maybe oil and gas exploration. So in 1979. Hecla Mining was the largest upside of any stock on the entire New York Stock Exchange. It went from 5 to 50 in 1 year, and got all the accolades of being silver stock and NYSE stock, going up tenfold in a year, and all that stuff. What's interesting is when I first started the Morgan Report, Hecla was almost at the point of being delisted, because New York, the NYSE has certain rules that you have to maintain to keep the NYSE listing. Hecla was at 50 cents at the time. So we put it on the list, buy it at 50 cents. So a few years went by, it was at $5. So it definitely had done the same thing it did in 1979 when everybody was jumping up and down and pointing at silver and saying, look at. No one was jumping up and down and saying, hey, Hecla went from 50 cents to $5. I was giving a lecture in Calgary, Canada. And I explained that we've got a 10 bagger on Hecla already, and no one's even mentioning it, So this is something that you can see from, my vantage point.
Well, that's because for many years, David, I mean, like Coeur d'Alene and Hecla, they had a history of bad deals. They were writing off bad deals. Their balance sheets were loaded with debt. They couldn't control their costs. I think Coeur d'Alene and Hecla, they did a bunch of reverse stock splits.
They're both horrible. I haven't owned Coeur in years, and I was criticized in the public domain on certain panels that people my age or older were saying, well, you don't have Hecla and Coeur d'Alene on your list. It's like, damn rights I don't. And so I agree with you. I mean, and that reason I got that 10 bagger was just because it was so oversold, and the bias. Most people that knew anything about silver markets that were my age group knew only two stocks, Coeur d'Alene and Hecla. That's all they knew. So if they were going to buy a silver stock, they'd buy one or the other or both. And I knew that, So, I mean, there's some advantages to age. But I offered it a 10 bagger. I didn't come back to that stock for a long time.
It also shows that people have to take, like you said, fresh eyes. They should look risk, reward, valuation, sentiment of a company. Are the assets actually improving? Are things improving at the company and people still hate it? So if there's an opportunity for that, if that sentiment is really negative about the company, but you do the research work and see that, oh, the assets are improving. Oh, the costs are improving. Oh, they're generating free cash flow. Oh, they just started a dividend. Oh, they just made a really pretty smart acquisition that a couple of years from now could really work out. Those are things that allow you to produce large investment returns over a couple of years. But normally then you're going to have to be a contrarian then, right?
Yeah, well, what I do now on premium service, the paid service, I used to do a rating, and that helps, but it's really hard to put a number on something because things change in business, especially in the mining business, where there could be a strike or a labor dispute or a flooding or,
well, look at Pan American. Look at Pan American Silver. That was arguably the quarter numbers that they just announced are arguably the worst that they've had in over a decade, maybe ever.
Yeah. No, it's very disappointing. Yes, you're right. So I kind of lost my train of thought, but basically, we like to spread out. We like to do the royalty companies. I feel that that's the sweet spot. We've been there for a long time. We continue to make money. I mean, most people say, well, I don't want to buy a stock that costs that much. Well, cheap stocks are cheap for a reason. They're usually cheap because they aren't worth very much. And a stock that's worth a lot is there because it means a lot. It is worth it. And, like Franco, one of my favorites, we had Royal Gold for a long time. I took it off the list because I wanted room for other investments. But either one of those companies have done what they started out to do. And, when you're financing other miners and you basically have a very small overhead with your staff, and it's kind of a win-win situation. Now, there are people that don't like royalty companies, but if they weren't worth it, they go to the banks. And the banks usually treat them worse than a lot of these royalty companies do. So I like it. It's a good place to be. In fact, we wrote an article on the editorial just a few months ago because we were getting a lot of questions from our members, our premium people, asking, well, what do you think is going to happen in the mining sector with, diesel costs going so high and, what we've already discussed with this inflationary spiral that we're seeing. And we broke it down and said, well, really what you want to do is focus on the royalty and streaming companies. That's what you want to do. And we did, lots of words and music about that, but there's a sound case to be made.
And the royalty and streaming companies, like other bear markets for metals prices and also for mining stocks, when capital is not available, that's when the royalty companies like Wheaton Precious Metals, Franco-Nevada, Royal Gold are being very aggressive historically. They're deploying capital. They're counter-cyclical. They're contrarian. And so just in the last 6 or so weeks, we've had Royal Gold do over $650 million in deals. Franco-Nevada did $350 million in deals. Sandstorm Gold did, I think, about $1 billion worth of deals. So there's Sandstorm just finished their acquisitions. So you're having, and then there's rumors of even larger mergers and acquisitions going around from Canadian investment bankers that Rick Roll talked about on my podcast interview a couple weeks ago. So there's just I really like the efficiency of the business model, and then you have your cost protected too. So I also get the same questions about diesel prices, electricity prices. Yeah, I cover mining stocks, but as for my own personal portfolio, my retirement account, I don't want to have to worry about that stuff.
Right. Yeah. No, that's well said. I mean, there's a way to, there's more ways than one to skin a cat, or whatever the expression is. And, we're in the mining business. And the thing about the mining business is the end product's identical. I mean, even Coke and Pepsi, I mean, they're basically sugar water with the cola in it, and they got a red can or a blue can. But they are somewhat different. But I mean, when you get down to gold is gold once it's refined at 9995. It doesn't matter if it came from the moon, Mars, or Zimbabwe, it's still gold. So now what you want to do is figure out who's got the best margins, who's got the best business model, who's got least capex, who's got the richest mine. You got to look at all the factors. And now, because it's easy to compare the end product, the cost of goods sold is gold or silver or whatever, lithium, whatever it is. But that's an interesting part of mining analysis, is you're not having any subjectivity as far as the end product is concerned. I mean, if I'm looking at like a fashion store that sells women's clothing, for example, you can't really, they're in the same industry, but there's variables there. It's what the public perception is. It's maybe the kind of models they use. It's, who they appeal to. There's, has to do with some advertising. When you're talking a gold stock, you've got to be really objective because it's the same darn product.
Exactly. Now, I want to ask you about silver supply. So we've seen the data come out from Peru, the data come out from Mexico. Annual silver supply from those countries, it's collapsing. So where do you think future silver supply is going to come from if demand for silver continues to grow globally?
Well, there's going to be opportunities out there. I'm not as familiar with Peru and Chile as I am with Mexico. And I am aware of a lot of assets that are not developed yet in Mexico. But, you got to get a good price, too, especially as costs continue to increase, so we keep discussing. So I'm pretty convinced we've hit peak gold. I'm not yet convinced we've hit peak silver, but you could hit peak silver in an unusual way. I think that bears some more time of your time. If we have the collapsing global economy that I've talked about and continue to, and we're discussing now, 70% of the silver market is a result of copper, lead, zinc, and gold mining. And if those are in a downtrend, that's 70% of the market. That has more effect than a primary silver mine because it's 70% of the market. Now, that's on aggregate. I mean, if you had a large silver mine that went under, like, say, Penoles or I don't know, what's another big one? There's one I can't pronounce the name, starts with a K in Poland. I mean, there's some pretty big mining concerns that are either primary silver producers or nearly so. That could have a big effect on the market. I want to be clear. But I mean, if you have on aggregate, copper dries up, we're not doing EVs because blah, 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 blah. I'm not saying that's happening. I'm just giving it a thought experiment. But what I'm saying is that you could get it in the back door. You could see where silver is curtailed production-wise, not because of primary silver producers, but because of the byproduct-based metal miners.
And there's almost zero new economic silver mines. I mean, you have the Mag silver mine in Mexico. That's an exception. I mean, that's a once in a generation silver mine. I think 400 grams per ton average grades, and the costs were very, very low. And then you have the Silvercrest Metals mine, which is they're pouring gold. They're not at economic production yet. Those are rare exceptions with grades and costs. I mean, the average potential silver mine is going to need $30, $35, $40 an ounce silver going forward.
Absolutely. I mean, I know Dr. McGaugh quite well. I'll call him Peter. He's been a bit of a mentor to me. He's taught me a lot, and he continues to have a good relationship with him. But I mean, MAG is an exception. And I have to say that we have one that's similar to that in possibilities. I don't want to overstate it. But again, will that project ever get to where MAG is now? I mean, I followed MAG when I learned the word. I mean, I was there on, I think, the first or second financing, and I didn't know any of these guys. I didn't know who Dr. McDowell was. I didn't know, and it's been a long time to get to where it's at now. And now it's basically, ramping up and, blue sky and all that's ahead of it. But you're right. I mean, it's a tough business and it doesn't happen overnight. And there's a lot more potential to not do than do. What does that mean? There's a lot more potential to see downside productive capacity with the current state of affairs globally than there is to see increase in production. I mean, that's a fact. And I think you're very smart to point that out to people, because the idea is, well, with high silver prices, everyone will just run out with their, they're picking their axe and they'll dig out a bunch more silver. I better rethink that. You're going to have to look at the environmental, the ESG, which is a big bugaboo now. You've got to look at if their labor force is even there. You got to look at what the diesel prices are. There's a lot of, let's say, roadblocks that are in place now that didn't exist, say, a couple of decades ago.
Also, David, the cost to build a new mine, and this is why a lot of new mines are not being built right now. The capital is not available, but the capital for most mining companies is not available, but also the costs are up. I mean, I think the cost just in the last 3 or so years, the costs are up over 50% in many different countries.
Yes, absolutely. I mean, we are at the end of these great inflations and, they don't end well. I don't expect this one will either. And the best way to protect yourself is to have real money first, which means physical gold and silver. And the way to gain leverage in the sector is to get in the correct mining sectors. And you don't have to have 27,000 stocks. I mean, I always laugh at the juniors and, I'm partial to the industry. And without the junior mining industry, there wouldn't be the majors. I mean, that's the way it works now and has for a very long time. But the idea that's given by some of the better known personalities in the sector are, well, I'll never buy a major because, we only do juniors. But they leave out the rest of the story. And the rest of the story is they have an advantage over everyone else. And that is they get to get in on the earliest seed round financings that public isn't even aware of or even has the opportunity to get into. And after the stock's gone up 5 or 10 times, they could sell it at a profit in almost every case. And then say, I'll only buy juniors. And everyone says, oh, if that guy's a billionaire, I know what to do. I only buy juniors. Well, if you follow that philosophy as a retail investor, it's a pretty good way to go broke. And I speak from experience because I thought the same thing when I was in my 20s that, oh man, I want to get the leverage. Now I did own some majors. I just, my conservatism came out from an early age, being somewhat conservative. So I did hold some majors, thank goodness. But almost all the juniors that I had basically went to zero. I mean, and so you got to be very careful, very selective, and you got to use risk assessment that you and I keep emphasizing. If you assess your risk properly, you're not going to hurt yourself. It's when you just go with the willy-nilly attitude that, well, if that guy's a billionaire and he only buys juniors, I'm only going to buy juniors. He's not giving you the full story.
Yeah, and there's also a lot of paid newsletter writers that have conflicts of interest too. So they're anti-royalty and streaming companies. I mean, I've heard this. I've been covering gold and silver companies now since 2009. There's a lot of paid newsletter writers out there. They love junior mining stocks. They hate producing mining stocks, and they really hate royalty and streaming companies. But if you look at the shares, the max charts of like Franco-Nevada, Royal Gold, Wheaton Precious Metals, those are the 3 stocks, and there's a few others that have done really well since 2009, despite metals prices most of those years either being flat or down. Those businesses continue to grow in the bear markets because miners needed capital. And then the royalty and streaming companies, and we're probably going to see more of this, if capital is not available to the miners, if miners need help with the balance sheet or finishing building a mine, the capital is not available, you're going to see Franco-Nevada come in and do a bridge loan for 80 million or 100 million. They're going to pick up a gold stream. You're just going to see them take advantage of the lack of capital available because their cost of capital is cheaper. And you mentioned juniors with the exploration upside. I mean, as a royalty and streaming investor, we get that exploration upside for free.
Right. Absolutely.
for free. There's no, we don't have to go and call or email the junior management team and ask them what's their cash burn rate, how much of their SG&A expenses are they actually spending on drilling versus going to mining conferences and staying in 5-star hotels or flying on first class planes.
Right. Now you know the industry. That's right.
Oh, I've heard some really bad stories that I won't repeat on a podcast.
Yeah, well, I've witnessed my fair share over the years, and I try to stay arm's length. Problem, I've learned from so many years is, those type of people I try to not get too close to, but I never really try to burn the bridge. And the reason is that in the next cycle or 5 years later, or maybe 10, they end up with a really great project. So if you burn a bridge, it's hard to, build one back. So I try to maintain a professional demeanor with everybody always and everywhere. But that doesn't mean I have to like them personally or their project. But I also don't want to be so subjective at a certain point in time that I'm not aware of. In fact, there's one company, I won't name it, that's a very strong silver company, but it started out as a pure pump and dump. But they stumbled upon a very good mine.
As I wrap up the interview, I have one more question. You brought up earlier in the interview, at the beginning of the interview, that there's crop failures and other problems with agriculture. Do you think that we're going to have a long-term food and energy crisis? Say something that lasts more than just a couple years.
Oh boy, put me on the spot. Well, I was going to say it's 2 or 3 years minimum. And I think I'll leave it there. I don't think it's going to be 10. I think 5 is the worst case. I think a few years, 2 or 3. I mean, humanity is really good at adapting really quickly to whatever conditions they find themselves in. And so, go back to the fall of Russia. The North Koreans starved to death, not all of them, but a great number of them, because they were totally dependent on Russia. But Cuba, under the Russian umbrella, their management team said, hey, it's all our land is owned by you, the people, go out and plant. And they had abundant harvests. In fact, 2 years into the cutoff from Russia, they were eating better and healthier than they've been in years. So, you got to look at both sides of the coin. One did nothing and the other did something. And so, again, and people will do what they need to do. So I'm not that pessimistic longer term, but I do, and I want to say it before we close out, we're going to have to hit bottom. And we're not close to the bottom yet. We've got to see the bottom in the stock market. We've got to see the crushing of the bonds, the stocks, the real estate. We got to get back to reality, what's important, what businesses really are viable and which aren't, what zombie banks and zombie corporations need to go bye-bye. We need to get real and do an assessment. It's kind of like cleaning the house. You got to get rid of all the stuff that doesn't work. Well, why are you holding that radio? It doesn't work. Get rid of it. Throw it away. And once that's accomplished, then we can see and evaluate what we have and rebuild. And I am convinced that we are on this downstroke right now. It doesn't mean the end of the world, doesn't mean everybody, panics, but it does mean we have to reassess, reevaluate, and basically get real again. And then from there, we can certainly come back probably stronger than ever.
As a libertarian, David, I would absolutely love deflation, free markets, capitalism, bankruptcies, allowing these large banks, these large corporations, these zombie firms to go bankrupt. No bailouts, no unbid government contracts, no secret subsidies, none of that. But unfortunately, that's not what's going to happen. Now, if you're a small business owner, you're a person on Main Street, you're shit out of luck. You don't have lobbyists on payroll. You don't have a staff of tax attorneys and tax accountants to help you get subsidies or come up with phony earnings to fool investors. So unfortunately, like the average person out there, the small business owner or middle-class person is going to get screwed. And the people who are corrupt here in the DC metro area in New York City with the banks, they're the ones who have benefited from the system for decades.
Absolutely. Well, I agree. I used to say on the Financial Sense News Hour very often that the right to succeed is the right to fail. And in a true capitalistic system, that happens. And the market naturally cleanses itself without these distortions that we've seen for so long. Always enjoy your interviews. You know, it's interesting doing an interview with someone that's really familiar with the sector like you versus someone that is not as familiar with the sector. It's just a more, let's say, more challenging interview in some ways, but I've certainly enjoyed it. Thank you for having me.
Sure. And if my listeners want to take a look at the Morgan Report or follow you on Twitter, how do they do so?
Just go to the main website, themorganreport.com. I've got a new landing page. It's a sales letter, I admit it, but there's a lot of free information there, especially if you're not familiar with what's going on in the economy. So I suggest you take 7 seconds to get your endorphins going, your dopamine fix, and scroll down a little bit. I did an interview with Stansberry Research. It is the most heavily watched video on Stansberry Research, and it's a personal record, over 2 million views, Jason, and it has to do with bail-ins. And if you don't understand a bail-in, you should probably watch that interview. It's free. It's on the landing page. Also, get on our free newsletter, themorganreport.com. It's an autoresponder. Just give me your email and then opt in. Say, yep, it's me. I want it. And then the blog is there for free as well. And then if you're interested in the equity side and what we do with our editorials and what we forecast and yada, 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 pull down the subscribe tab and you'll get an outline of what we do, what you get, and what you see in the Morgan Report, which is different from, let's say, the more, we say, cookie cutter type of newsletters that are out there in the same space.
And I'll also plug your book, The Silver Manifesto. That's on Audible. You can also get the audiobook on you can get the regular book on Amazon or the audiobook on Audible. It's a good book about the silver market manipulation, long-term prospects for silver.
Exactly. It's not on Amazon anymore. Well, let me restate that. What's on Amazon is used copies at exorbitant prices. So if you just go to the books tab on themorganreport.com, we mail them directly. And it'll be a much cheaper price than some of these people that are gouging on Amazon. I took it off of Amazon for a variety of reasons, so I'll just leave it at that.
Oh, I was going to ask if they censored you. What a crazy world we live in, right?
Exactly.
Well, David, thank you so much for your time. I really enjoyed our discussion today.
Me too, Jason. Thank you.